Hello and welcome to CMC Markets on Tuesday the 6th of August and the weekly market update. Coming off the back of a weaker than expected payrolls number last week, coming in at 162,000. Nevertheless, despite an initial tick lower in US markets, we've continued to make record highs, even though the May figures and the June figures were revised lower. Nevertheless, I think investors have taken the attitude that the weaker number is probably going to make it much less likely that the Fed will be as keen to start looking at tapering their asset purchase program at the September meeting in the coming weeks. Now, whether or not that is the case remains to be seen. Other US economic data has been fairly positive. But for the time being this week, US equity markets, European markets, and UK markets have been largely lackluster, despite the fact that economic data continues to come out on the better side of things, particularly here in the UK. And I think that's really what I want to focus on for this week. I'm going to focus on the pound because we've had a whole host of better than expected UK economic data over the past 7 days. We've had very good PMI numbers, not only in the services sector, but also in the manufacturing sector, the construction sector, as well as the composite sector, which is an amalgamation of the manufacturing and the construction sector. We've seen growth in all those areas. We've seen revisions higher in some of the Q2 numbers, which does seem to suggest that we could well see a revision higher in Q2 GDP. We've also seen retail sales, BRC retail sales, coming into the highest levels since 2006, a year-on-year rise of 2.2%, as well as seeing an increase in house prices. Now, that's not necessarily a good thing because I think that's largely driven by Mr. Osborne's, what I would say, rather misguided help to buy scheme. But nevertheless, the UK economy does appear to be ticking along nicely. However, the pound does appear to be struggling, and it's the pound against the dollar I'm going to be looking at in the context of this improving economic data. Also previewing the UK inflation report, Mr. Carney's first proper press conference since he took over at the beginning of July. And I'm also going to have a look at the Australian dollar in the light of the 25 basis point rate cut by the RBA earlier this week. Okay, so let's start off by looking at the pound. Now, we've been waiting an awful long time for this inflation report, ever since Chancellor Osborne announced the fact that in the March budget he will be basically giving the go-ahead for the Bank of England to look at other measures to measure monetary policy and looking ahead towards forward guidance. Now, I think one of the key caveats that he placed on this research document that the Bank of England is doing and the inflation forecast going forward is the fact that they needed to maintain their inflation target, whatever that means, given the fact that they've missed it for the past 5 years. But you know, let's not let facts get in the way of a good story. Anyway, all eyes will be on Mark Carney tomorrow. Will he give forward guidance? And if he does, will he tie it to the unemployment rate to a particular level, maybe 7% or 6.5%? Will he tie it to average earnings? Because average earnings for quite some time have been a severe laggard when compared against the inflation numbers. Will he revise down the inflation forecast? Will he revise up the growth forecasts? The key concern, I think, going forward is where is the pound going to go going forward? Because I think Mr. Carney has to be very, very careful about talking the pound down too aggressively, because we've seen the effect that a weak pound has on the inflation numbers. And I think one of the key factors that we've seen out of the data that's come out over the past day or so, or the past week or so, has been the fact that this growth that we've seen has been largely as a result of growth in the services sector, which you can argue is the wrong type of growth, because UK consumers continue to be very cash strapped, high inflation and below average earnings increases. So I think a falling pound could well be bad for growth going forward unless the necessary rebalancing actually takes place with respect to the manufacturing sector and the construction sector. Anyway, the key level that I'm keeping an eye out on, and it can be displayed on this chart here that I've got up in front of me, is the 154 level on the daily chart. The 154.35 was the July highs. That's going to be the real key level for any further sterling gains. But even if we do get above that, we've also got the 200-day moving average, which comes in around about the 155.40 area. So on the top side, I really would like to see a move above 154.30 to target further upside. Otherwise, we are at risk of a correction lower, and we can certainly see that on this 4-hour chart that I'm just about to show you here, where we can see that the slow stochastic oscillator is looking extremely overbought. So I think in the event of a dovish inflation report tomorrow morning, then there is potential for the pound to fall all the way back to 151.45, which is the trendline support that I've drawn off the lows that we saw at 148.10. So I think those really are the key levels with respect to the pound. It's looking a little bit overbought at the moment on the 4-hourly charts. That's not to say that we can't go any higher, but it really depends on how dovish Mr. Carney is at tomorrow's press briefing. Let's quickly wrap things up with the Australian dollar. Now, the Australian dollar has been in a significant downtrend for quite some time now, and the RBA, as expected, cut interest rates to all-time lows at 2.5%. As a result, we saw a sharp rebound in the Australian dollar. The key question now is are we due a rebound? Now, the RBA statement, we've got a monetary policy statement later this week that's due to be published. I think if that comes out on the less dovish side of things, and Chinese data later this week actually comes in slightly better than expected, then we could well expect a significant short squeeze in the Australian dollar, because shorts are at record levels at this point in time. We've also got the fact if US economic data continues to remain weak, then the likelihood is we could see the US dollar weaken. So I think the risk is at these levels of a short squeeze on the Australian dollar. And I think we could well be in line for a test above the 90 level. We need to sustain a move above the 90 level, and that could well open up further gains towards around about the 92.50 area. Okay, so that's pretty much it for this week. Once again, thanks very much for listening. This is Michael Hewson talking to you from CMC Markets.